Hi everyone, it's JJ Conway. I want to thank you for coming to the financial seminar. I did want to cover in a little bit more detail a couple things that we didn't dig into during the class, and that are the different types of investments. You see, in the class, we had most people that were still in debt, and very few people were even at the point yet of being able to really invest significantly in the market. So I didn't spend much time going through those. But I'm going to do that real quick here. Now, before I do that, first I want to kind of outline what I, as a financial planner, would feel more comfortable with as far as suggesting that you invest in the market. Okay, the very first thing that I would recommend is that before you invest, that you have a sizable savings account to handle emergencies as well as being out of debt. Now, when it comes to an emergency fund, I talked in the class about having a 6 to 12 month emergency fund and how much of a difference it made in my life to have such a large emergency fund after that second car accident within 8 months. Okay, so it's very important to have that. When you're just getting started, though, you may not be able to get 6 to 12 months of savings together right away. So we at least recommend $500 to $1,000 depending on your income. That way, as you're getting out of debt, if something else happens, you've got the money to take care of it. Your car overheats. I mean, yesterday it was, 115 degrees out here. Your car overheats and you're still fine. You can go get it fixed because you have the money in the bank. You don't have to go build up more debt. Okay, that's what a starter emergency fund will be for. $500 to about $1,000. Then after that, I really do recommend that you get out of debt. Now, those of you who are saying, hey, but wait a second, my credit card is at 12% and I can make 18% leveraging real estate. Let me do that instead. Let me just ask you to bear with me for a second. See, financial planning is not about, financial planning is about numbers, and financial planning is about math. But behavior is not about math. If behavior was about math, all of us would be better off financially. Behavior doesn't care about the math. Behavior cares about the heart and the mind, okay? And so I understand that there are different products that you can leverage, but for most of us who are in debt today, we're paying 12%, 18%, 24%. I had somebody come to me one time with 36% debt, and they did not want to pay off their credit card. They wanted instead to leave that debt where it was and use their cash to invest in their Roth IRA because the money would grow. But here's the thing. You're paying 36% interest. Even let's say you have a good credit card and you're only paying 12% interest, okay? On $18,000, that's still about $200 a month that you're paying in interest every month. If you had invested that $18,000 in the market, you might be making in today's market 8 to 10%. You've already lost a 2% spread on that money, plus the $200 a month you're paying on that interest could also every month be investing in the market. And so you're not only losing the money that's in your current pocket, you're not only losing the insurance out of your the interest out of your current pocket, but you're also losing the opportunity cost of what you could do with that extra money if you were investing it. Remember my Super Bowl example. Every year until my husband had that revelation, he was losing out on being able to go to any Super Bowl he wanted. Now that's a little fun example, but I hope something in that rings true for you today. So I highly recommend that we pay off debt first. Once you finish paying off debt and you start putting that money into the market, trust me, you will be able to build wealth. And so once you're able to start investing, there's different things that we talked about in the class in ways to invest. We talked about mutual funds, we talked about ETFs, and we talked about real estate. Now, I am a huge fan of set it and forget it when it comes to mutual funds and ETFs. So let's talk a little bit about those. Now, y'all know I'm a super huge fan of real estate. We'll get to that in a second. Mutual funds and ETFs, they are both funds in that you're pooling your money together with other investors. This allows you to diversify the quality of your investments. Remember the example that we had. You know, Coke may be plummeting right now, but something else might be taking off. And we gave some different examples of current world events that could be very hot right now. Some things such as CBD oil are taking off. Other things such as I'm drawing a blank, but there are other things that are taking off, but then there are other brands that are tanking right now. And Coke is not one of them, so please don't accuse me of slander. I was just using an example. When one goes down, another goes out. That's why you don't want to just invest in one stock. You know, it's very easy to say, oh, I'm going to invest in Apple. It's great. I had somebody else tell me they were putting everything into CBD oil right now. Great. You're making money? Great. Make money. I'm not a big fan of investing in things that I am not ideologically aligned with, so I have to be a little bit extra careful about what I invest in. But the bottom line is you don't want to just invest in one thing. You want to invest in a pool of things so that you're protected against risk if that one thing tanks. Remember my barbershop story about Kmart. Just because something sounds like a good deal and just because a company's been around for decades doesn't mean it's going to be a good money maker for you. You could find yourself the next day with nothing to your name when the company declares bankruptcy. Diversification is key, and that's what the mutual funds and the exchange traded funds do for you. They pull all of your money together with other investors, and then they go out and invest in different companies in different pockets of sectors of commerce, okay? So the difference between a mutual fund and an ETF, there's a couple of differences. They're both investing in the market, and in the case of mutual funds, they'll usually design a mutual fund to invest in certain aspects of the market. So maybe this fund is going to invest in growth, and they're going to invest in a lot of companies that are taking off. But you know, the more risk you take on, the more risk the more money you make, the more risk you take. That's the company's growing fast, but a lot of them are dying fast too. You know what I mean? And so then you have funds that are more stable. You'll have funds that have a mix of those. You'll have funds that have bonds mixed in and other different things like that to try to balance it out. There's all kinds of different mixes, all right? With the ETFs, they are generally going to be based on the market. And the cool thing about an ETF versus a mutual fund, and I'm a fan of both, but the cool thing about the ETF versus a mutual fund is that the ETF is traded kind of like, it's basically following an index, traded like at the stock market, but you're not actually paying for all those trades. See, if you were buying and selling and buying and selling and buying or selling yourself as a day trader, or if you were doing a mutual fund that's constantly buying and selling, every time you make money, now you're racking up capital gains tax. And so one of the great things about the ETFs is you're not taxed on that money until you sell the fund. Now, in a mutual fund, you're taxed when you sell the shares. So if I give my money to a mutual fund, mutual funds are very powerful and they're very stable. Excellent product. If I give my money to a mutual fund and they sell shares and rebuy shares and they keep doing those kinds of things every month, you could be on the hook for a lot more tax liability than you would if you were in a mutual fund that buys something and holds it for 2 years. Buys more and holds it for 2 years. You're still putting money in every month, but they're not selling every month. So you want to look for those kinds of things to help keep the cost down. The ETFs being just basically based on the index, they're not going to have a whole lot of day-to-day management, so your costs are going to be lower. But the ETFs, you kind of get what you get. It's going to be basically along the lines of an index fund, and you're going to get whatever's in the Dow Jones or whatever's in the S&P 500, okay? That's what you're going to get. One of the great things about mutual funds is being able to find funds that are customized to your values and your personality. So, for example, the IRAs that I'm opening up for my boys because they've started working, the young one does modeling, the older one does modeling as well as office work. The IRAs I've opened up for them are through something called the Timothy Fund. The Timothy Fund invests in a way that's aligned with my personal values. You can find funds that are investing along the lines of your personal values. Now, you may pay a little bit more in management fees, but if it's important to you, it's good to know that those opportunities are out there. All right, now on to my favoriteest type of investment ever, and that is real estate. I love real estate. I've got all kinds of real estate courses. Interestingly, I'm looking at my my two books here, my two bookcases here, and I don't have any of my stuff in here. I need to fix that. But I've got all kinds of courses on real estate. You know, I was the founding treasurer of the Maryland Association of Professional Professional Foreclosure Consultants. You know, so all kinds of real estate goodness. Here's one I really love. And you're not going to find a lot of people talk about this at your real estate investment meetings, but this is one of my favorite real estate books ever. This is the one that got me started. It's called Building Wealth One House at a Time. And the premise is you don't have to go out there and leverage $1 million worth of debt. You can actually get a property, stabilize it, and you can build wealth. You can build financial independence in as little as 7 to 10 years. How awesome is that? Okay, the reason I like real estate so much is because real estate is one of the most repeatable and ethical and consistent methods of building wealth I've ever seen. And what I mean by consistent and repeatable is if I follow the rules of real estate investing, like what I teach at the Pierre Bossier Mall every first Saturday at 9, if I follow those rules, I will make money. If you follow those rules, you will make money. See, there are businesses out there where you and I can follow the same rules and you'll make money and I won't because of my personality, my connections, what have you. Okay, so even when I teach my real estate investing class, I talk about how some people who are in the class, who are well connected in the community, can actually make money that night or that week with real estate investing, even if they never buy the house, because they're well connected. Somebody else may not be as well connected. They may not be able to make money that night, but they can make money with the process. There is some network marketing and other businesses out there that you could buy into, and your personality, it may be personality dependent. And so this person makes a lot of money because they have the gift of winning others over. They're very charming. They're very charismatic. Their family is connected. They have money. They know people with money. That person over here could make a lot of money with certain network marketing businesses. Someone over here who's a military transplanted to a community where nobody knows them, where they're not connected, they haven't been able to hobnob and build those connections yet, they may not make good money. But the cool thing about real estate investing is if the numbers work, you make money. Whether people know you or don't, whether they like you or don't, whether you've lived there all your life or don't, whether you have money or you don't. The numbers don't lie when it comes to real estate investing. And so I encourage you all to get with me if that's something that you're interested in. I've got 2 versions of the class on my website right now, jjconway.org or jjconway.teachable.com if you want to go straight to the class page. I've got the 2018 version of Real Estate Investing 101, and I've got the 2019 version of Real Estate Investing 101. And when you buy the 2019 version, we give you a discount on the 2018 version. The reason I keep each version is because they each have different things. And for those of you who are watching this that weren't in the Shreveport-Bossier class, but you are actually in Maryland or Virginia, then you want to get with me offline because I still have the recordings from the 2016 and 2017 versions of real estate investing. And those are tailored for those 2 states respectively. All right, I think I've covered everything I need to cover except one last concept, which I'm not going to cover in this video, but I'm actually going to send you another video on that, okay? And that is, what is an investment? Now, we talked about 3 investments right now. We talked about mutual funds, we talked about exchange-traded funds, ETFs, and then we talked about real estate. But I have a whole class that actually walks you through what is and what isn't an investment. The class itself was motivated by a friend who came up to me and told me how she had just bought a Porsche. And in her book, it was an investment. In my book, a new car is not an investment. Now, it may be a business expense. It may be an entertainment expense. It may be an absolute wonderful thing to have and drive, but it is not an investment. I'm going to go over my definition of what actually is an investment, and then I'm going to walk you through some samples when it comes to things like cars and rugs and businesses and real estate and purses. And I mean, we always want to call stuff investments. Have you ever noticed that all the salespeople call things investments because you're going to invest in yourself? They make you sound like you're doing something good for yourself. Well, we're gonna pick that apart, and we're gonna look at when we're doing something good for ourselves versus when we're doing something good for their paycheck. All right, and we're gonna talk about what's an investment so you can keep more of what you've earned, and so that you can craft the legacy that you desire to live. I'm JJ Conway. Thanks again for attending the seminar, and thanks again for watching this video. Y'all take care and be blessed.